I think the key here, I mean, in terms of being an active manager, Sandy, you guys are doing a lot of deep dive research. You're getting to know your holdings very well. You have a relationship with many of them.
Yes.
In terms of a regular dialogue that you maintain with them, and you know what's happening on their balance sheet. We've had discussions with passive investors.
Yes.
In corporate debt, in credit market, in the corporate
Yes.
debt market. And their attitude is more sort of generalist, and well, as you can imagine, because they're passive investors. And so they've been making the case, of course, for shortening duration. Now, in your case, your thesis, when we've talked recently in the past, your thesis was that you would rather take the credit risk than the interest rate risk.
Right. Credit spread risk.
And the argument from the passive side was that risk management in terms of maturity dates is great until it's not. If the market goes sideways like it did in the past, then all of that liquidity that's supposedly there tends to go with it. So what would your counter argument as an active manager in the space be to that thesis?
Well, first of all, let's talk about active fixed income versus passive fixed income, because fixed income is a fancy word for lending money. Anytime you're in fixed income, it just means that you're lending money out and you expect to get back the coupon over time, and then at the end of the period, you get your principal back. And obviously, there's government fixed income, there's corporate fixed income, which is mostly what we do. I think that passive fixed income in the corporate world, lending money to corporations, is very, very perverse. And the reason it's perverse is when you think about what you do when you lend money, you're trying to get your money back. So to get your money back, you want to make sure that there's asset value there, that the company is a good company, it's a good solid credit. And if you're a passive fixed income manager, you're making your decision solely on your lending decision solely on who has borrowed the most money. How does that even make sense? That's as if you're a manager of a bank branch and you're trying to decide who to extend mortgage debt to, and you say, you know what? The next 10 people that walk in, the 5 people with the biggest mortgages, I'm going to write those mortgages. So it doesn't, the passive fixed income, especially in corporate debt, doesn't really make sense. And I'm going to go back to the example where we talked about iHeartMedia.
So on that line of thinking, it truly is great until it's not great anymore.
On the passive side?
You're right.
Yeah, absolutely.
I mean, when you make the argument that you're going to keep on lending money to the biggest borrowers, sort of a bottomless lending pit.
Yeah.
But then when things go sideways.
When things go sideways, and it's, passive anything by definition, passive means that you're letting someone else do the driving for you. And that's really, as an investment manager that specializes in research and credit, it doesn't really make sense for us to let someone else do the driving. So, back to the example of earlier, the big bankruptcy in 2018 has been iHeartMedia, and that's an example of an industry. We don't want to lend money to traditional radio, and there's a lot of secular decline, kind of old school industries out there that still require a lot of capital. And some of these are the biggest issuers in the corporate debt world. And, the great thing about being an active manager is I don't have to lend money to companies that are in the traditional telephone business, or I don't have to lend money to companies that produce newsprint. I can make sure that when we're lending money to a certain industry, that the supply and demand dynamics make sense for us, as opposed to making decisions based on simply what's out there. I mean, corporate debt in the States, even just non-investment grade corporate debt, is a $2 trillion market. There's a lot for us to choose from. Yeah,
and you have the opportunity to cherry pick.
Absolutely.
There's a tendency, I think, in the marketplace from investors to think of the high yield space or the corporate credit space in sort of a one-dimensional way, which is, that's risky, or, I don't understand. They don't really truly understand how it works.
Yeah.
And so they don't necessarily understand how to take advantage of an active approach to credit investing.
Absolutely. And also, being Canadian, the selection of issuers we have in Canada versus what we have in the States is it's small. I mean, there's a lot of banks, there's a lot of insurance companies, there's a lot of energy-related issuers, and then it falls off very quickly after that. But in the U.S., there's many, many industries that we can lend money to in industries that make a lot of sense, that are growing, where the supply and demand for whatever good or product they're selling makes sense. And so we have a lot of selection.